I was actually taking a walk with my best friend. Suddenly, out of blue, he asked me, Lakshmi, if you die today, what your wife and children will get tomorrow? I actually was spending like there is no tomorrow. Rate of saving is less than 5%.
Welcome everyone. Today's guest is S. Lakshmi Narayan, a wealth and retirement strategist. So, sir, you say you started late, but you still became financially free in just 7 years. Most people take 20 to 25 years. So, what did you do differently that others aren't doing?
Correct. When I started at the age of 50, there were several factors in favor of me. Though I have not saved until the age of 50, first thing, I had a very high salary at that time. It was around 3.5 lakhs per month. So I could save about 60% of it because my lifestyle is not a very grandstand. It is very simple. I have made it very simple to save. The second thing is when I started investing, I invested in equity and equity mutual funds. So my education in chartered accountancy gave me the knowledge, experience, and training to do fundamental research on companies and also to make risk adjusted returns on mutual funds, right? So I selected the best equities, best uh, equity mutual funds. These are the two instruments that I use that I know can create wealth faster than any other instruments. The second thing was I started in the year 2007. So 2008, the stock market went down and my own portfolio went down by 80% because I started only in 2007. I purchased 2007 was when the stock market was high. So I purchased when the thing is high and it all fell down in 2008. Because of my high salary, I didn't have to resort to sale of mutual funds uh, for my day-to-day living or for any emergency that I may have. The third thing God helped me is He didn't give me any emergency. No medical admission for me or my family or for my parents at that time. And no emergencies have come during this period. These are God sent. Okay. So this accelerated my wealth journey. There are a few mistakes I have done. One is putting everything in equity and equity mutual funds. At that time, I did not know the danger, but I was also in a hurry to create wealth for my retirement corpus.
If you're finding this useful and you want to learn how real people actually build financial freedom, I share conversations like this every week. So, please hit subscribe. It really helps me bring more guests like this.
So that is one thing which I did not create an emergency fund. But what I did right was getting a good life insurance cover for myself for 1 crore. I took it at the age of 50. So I had to pay 1,50,000 premium even back in those days. I took that and medical insurance cover. So if any medical emergencies have to happen, I got it covered by medical insurance. This I did right. The selection of equities and equity mutual funds, I avoided the noise created by TV. Today we have got influencers, but at that time we have got TV the experts doling out advices on mutual fund and equities. I carefully avoided it. So I did my own research. So I selected the best equity mutual funds and equities. So I didn't do anything when my portfolio went down by 80%. I kept quiet. It did not rise for the next 2-3 years, I think. After 4 or 5 years only, I saw my portfolio. It has given me fantastic returns, more than 20 to 22 in those years.
Right.
After that, of course, the returns have come down because once the cheaper valuations have gone, then you come into higher valuations, and from then on, the returns were normal. So I had a very abnormal CAGR in those times between 2008 to 2013, and that helped me to create wealth at a greater pace.
So, sir, when did you realize that you were behind on this whole retirement planning?
Yeah, actually, I did not have any realization at all in my life. Until the age of 50, I was actually taking a walk with my best friend. Suddenly, out of blue, out of context, he asked me, Lakshmi, if you die today, what your wife and children will get tomorrow. So I was really taken aback. I couldn't sleep that night. The next day morning, I sought out an insurance advisor. See, in India, insurance advisors seek out clients, and it is very hard for them to get a client. But I sought out the nearest insurance advisor, and I took an insurance cover of 1 crore. That was in the year 2007. So at the time, 1 crore is a good amount of money for a family of three to survive, my wife and two children, and also for their higher education. So the first thing I could do is create 1 crore corpus for my family, paying 1,50,000 premium. Right. Of course, I always had medical insurance, so that was not the issue. So that is
Right.
so when he actually posed that question, I realized, yes, not only I have to provide for my family the next day because death can come anytime, but also I have to think of my retirement. It's not that I'll be going on like this forever. Okay. And also I had another goal of educating my children and also providing a little bit of corpus for their entrepreneurial activities. Both of them wanted to be entrepreneurs. They did not want to take placement at the colleges. And therefore, I had to provide for capital, initial capital. After that, they took off by
Right.
themselves. These are the two goals I had. I had given myself 10 years. And because of the 2008, it became 7 years.
Right. So before 50, sir, what did your portfolio look like? Like I'm assuming that even that time you were really conservative in your spending and things like that.
No, no,
But
I was
what
not
was
conservating in my spending. I actually was spending like there is no tomorrow. Rate of saving is less than 5%. That is the reason why before 50, I had one third share of house, which I built it along with my brothers. So it was quite a big house at that time. So that was funded entirely from the rent. We designed it in such a way that we rented it out, and the EMI came from the rent directly. So we didn't pay much out of our pocket. Very insignificant amount we paid out of our pocket, but not much. I had a few lakh rupees in savings bank account and probably 10 lakh rupees in mutual funds. That was my actual net worth. It was almost nil.
right? So, sir, I know you post a lot about investing and the philosophy online, right? So, what kind of investor should not try to copy your method, right? Like after 50, I know you had a great run, but like, why should people not actually copy your strategy?
First thing, after hearing my case, they should not expect that they will achieve financial freedom by 7 years because there are so many factors which help me to do it. A person in 30s, for example, he can hope to retire within 15 to 20 years if he follows the step. It is more of a common sense than any rocket science, I would say, right? For anybody to follow, first thing they have to do is life insurance and medical insurance. Medical insurance, of course, I did it at 35. I should have done it at 25. I could have saved a lot of premium. Similarly, life insurance, I did it in 50. I should have done it again in 25. So, anybody who wants to retire early should first get these two things done. Of course, life insurance you have to keep on taking until it becomes 2 to 3 crores because there's a restriction on the amount that the life insurance companies will give will insure your life, right? It is depending on your income. It is almost between 15 to 20 times your annual income. If your annual income is say 12 lakhs, so they can give 1.8 to 2 crores. There's a method to calculate how much life insurance you require for you and your family. It all depends on the liabilities you have. It all depends on the goals that you have. There's a scientific method of calculation. So first thing, once a person has an income, either salary or business income, they should do life insurance and medical insurance adequately. Then they have to create a contingency fund which is invested in debt instruments, which is easily encashable, highly liquid, safe, but gives a little more interest than fixed deposit. little more income or return than fixed deposit. They are mostly debt mutual funds who can put in emergency funds. Many of my clients ask why not in high yielding fixed deposits. But fixed deposits, you cannot actually, it's not liquid. You cannot encash it before the term is over. If you encash it, there are penalties and interest. So fixed deposits are not suitable. So you can actually go for debt mutual funds because you can easily encash when you need it. Second thing, they don't lose the principal and they give a little more interest than fixed deposits interest in India. All I'm speaking about is in Indian context. Then after creating contingency fund in debt instrument, then only they have to go for wealth creation. Again, wealth creation is a game of persistence. Many people, they start an SIP, then they think this fund is yielding higher returns. Then they stop that SIP and create another SIP and go on. Go on, actually, whatever is the flavor of the season in investment, which the influencers and YouTube and TV people give, they hop. They must avoid this. See, when I did my own investments, the same mutual funds I continued, same equities I continued, but I reviewed their performance. If the performance is within the acceptable standards, then I never switched. Of course, there are few switches because I saw a risk in some of the things at certain point of time. So only when you sense risk, you have to actually switch. Otherwise, you carry on with the same investment instruments which has been selected over a period of 10, 15, 20 years, because after 10 to 12 years only the compounding effect starts. Until then, you don't see much of your net worth growing. So you have to treat your SIPs like your loan EMIs. Loan EMIs, you don't give reasons not to pay. Similarly, SIP, you should not give a reason that you will discontinue and then continue at a later date. This is another mistake that
Right. But
people do.
here the banks are asking, banks will be behind you if you don't give the EMI. Here
Correct.
in the SIP case, nobody is actually sitting behind you to, give that money. So I think that is why a lot of people, they are fine discontinuing the SIP, but they continue paying the EMIs.
Correct. What I did in my own case, so I don't miss a SIP, is automate them. On my salary day, I have given the SIP date for all my investments. So at the end of the evening, everything is debited. So what I see is the salary after my investments are gone. That is what that automatically becomes my budget for the month. See, where up to 50, I had this equation. Income minus expenditure is equal to savings. But expenditure rises exponentially with the income also. Income rises exponentially. Similarly, your expenses and the status symbols that you acquire also increases exponentially. Okay, because you care about what others think of you. You live for others unless you have the financial freedom. When you stop bothering about others' opinion. So, what
Yeah.
the investors should do is to automate the SIPs to hit on your salary date or on your income date. The third thing, this advice is for startup founders. It is called pay yourself first. The first payment in the month, whatever happens, even if your business is upside down, is to your own investment account. After that, you manage the
Mm.
funds and prioritize. So, startup founders usually don't take salaries because they think, okay, I will grow the business up to a certain level and then I will take business. Okay, in business, there is no certainty, right? So, startup founders should follow the principle of pay yourself first. Take some amount, whatever be the amount that you think is appropriate to your business. Take that amount and put it in SIP. So the first income, business income for the month, you should put regulated SIP. That is other advice. Otherwise, wealth creation is a game of persistence. So you have to put the 180 or 240 installments and you have to step up whenever your income increases, whenever you get incentives, whenever you get bonus. A certain percentage of that increment and the uh, bonus or incentive should go to your investment account. So we call it a step-up SIP.
Right. So, sir, can you talk about it?
About
Right.
step-up,
Can you talk about it in percentages? So I know you started with having no. So you started with contingency, right? So you need to have this much contingency, and then
no,
the
I
rest
didn't start
can
with
be,
contingency. In
you
my own
know, your
case,
investable income.
no, in my own case, I didn't start with contingency. That's a mistake. I started with wealth creation straight away. After sorting out my insurances, I went to wealth creation straight away. That's a mistake, actually, which people should not adopt.
Right. No, no, I'm saying when you were giving advice, right, you started saying that people should build for contingency, then
Correct.
they should go into investing, right? And
Correct.
then you should have a debt mutual fund. So can you talk about a little bit of percentages, like how much of their portfolio should be in contingency, how much should be in debt, and then how much in when you are investing, how much should be in mutual funds, how much should be in actual stocks, so things like that.
Okay, contingency fund is your 12 months expenditure. Before
Okay.
COVID, we used to give 6 to 9 months expenditure. After COVID, 12 months your take home income after tax should be in your contingency fund. So your income rises, accordingly your contingency fund also will increase. So every year you have to review to see what is going to be my next 12 months income, and accordingly adjust the emergency fund. So your first contribution of your savings should be in contingency fund. Second thing, rate of saving depends upon one's circumstances. See, I cannot dictate, of course, 40% to 60% is the ideal savings rate, which means you get 1 lakh after tax per month. Your ideal savings should be around 40,000 at least. But many people pay 40,000 as EMI with 1 lakh
Right.
as the take home pay. 40,000 is the EMI is what I'm seeing. That is a wealth depleting, making yourself poorer step, right? So savings rate is individual based. It has the rest goes to equity mutual fund. If you are new to wealth creation game, then mutual fund is only your option. Is the only option that you have. You cannot go into direct equities and other instruments because they are very risky and they can wipe out your capital. Why can't you do direct equities? Means you should be able to afford a SIP of 1 lakh because you have to diversify across 30 shares at least. You cannot buy 1 or 2 shares and try to benefit from it. If the 2 shares go down the window, your capital also goes down the window. So equity mutual, if you are new to wealth creation game, until you create a corpus of 8 to 9 crores, 8 crores,
Okay.
usually we are a little conservative. We say 10 crores, but 8 to 9 crores is also okay. Then you have a PMS.
Hmm.
They are high risk. They are products tailored for HNIs. They have the potential to produce high returns. They have very high fees. If mutual fund is charging you 1% fee for a direct fund or zero point 0.5 or 0.75, these people will charge 1.5% fee upfront plus 20% of the profit over a hurdle rate. Hurdle rate may be anywhere between 8 to 11%. So if PMS makes 20% returns, 28% is the hurdle rate. So 20 minus 8 is equal to 12%. Of that, 20% is equal to 2.4% as performance fee, plus up to 1.5% as fixed fee. So it can be around 4.5%. It can all add up to. Net of these charges, pre-tax returns, some of the PMS returned more than the equity mutual funds, portfolio of equity mutual funds. So
Yeah.
if
So
you
I
are,
think let's get into this a little bit more, right, sir? So what I want to know is who should actually focus on mutual funds and who should actually go for the PMS strategy.
okay, equity mutual funds are suitable for early investors, those who have not created wealth, those whose financial assets are less than 8 crores. We don't include the residents here because you don't intend to sell. and there is no income from it. So we exclude that from your net worth. And if your net worth other than your residence is 8 crores, then you should stick to equity mutual funds only. If it is above 8 crores, then a certain percentage can be given to PMS. Though PMS in theory, you can invest 50 lakhs is the minimum amount that you have to invest. But in our analysis, the good performing PMS who has given returns in all time frames, in most of the time frames, in all time frames, no PMS can give good returns. But in majority of the time frames which has given good returns, they have increased the minimum ticket size to 1 crore. So if you want to invest in the best of the best PMS, then 1 crore is the minimum because they don't want to deal with people who have got only 50 lakhs.
Right.
After 8 crores, your CAGR of your net worth can grow at a higher pace by at least to 2 to 3% compared to your equity mutual funds, both pre-tax. So one has to be mindful of the tax component.
Got it. So, sir, if someone comes to you and says, Lakshmi, I have 15 to 20 mutual funds, I have some gold, I am invested in some random stocks, I have some stocks from my company, and I don't have any retirement plan, right? So, where should they start from?
See, they should first start from how much money I require in this lifetime. First, you should know the goal, isn't it? So, first thing, calculate what are your life goals. In which year you want to achieve those life goals. Then you have to inflation index. Today, a house is costing 1 lakh, 1 crore. After 20 years, I want to purchase my house. So it will actually have an inflation, right, of 8 to 10%. So having that inflation, how much would be the value of the house I want to buy after 20 years? It may be 5 crores, 6 crores. I'm giving an example, right? So 5 crores, 6 crores is for my house. Similarly, for my children's education, how many crores? Today, how many crores it will cost? After 10 years or 15 years, how much it will cost? Then you have to calculate your retirement corpus for your living. So you should be very careful because you have to provide for the highest expenditure in retirement, because retirement is a place where you can travel both nationally and internationally, where you can have leisure activities. Okay, you have to provide for all those. And also your medical expenditure is going to be high. So you have to provide for higher medical insurance premium. Of course, you don't need to have your life insurance because you have already got the corpus cash flows. It's not that at the end of it, if I have 50 crores, I'll be good. No, but year 10th, you may have requirement for 2 crores. Year 7, you may have requirement for 3 crores. So you'll have to calculate in which year I want. Not only lifetime cash flow has to be calculated in terms of total amount, but also in which year you want. Your investment goals should align with the cash outflow that you have made. This most of the people do not have. Okay, they just randomly invest, and after some time they get a fear whether I'm doing or not. Then they go to a financial planner.
But sir, how can I predict what my income will, like what my expenditure will be for the next 50 years, right? For example, let's say I am a 30-year-old
Correct.
and I'm going to live till 100, right? I have 70 years in front of me. So how do I figure out all the expenses that I'm going to have, right? Like you don't know, there are uncertainties.
See, similarly, a financial plan is a living document. You start with what
Hmm.
you know. Okay, we give there's a template which financial planner, every financial planner will give it to you. So you fill the template. You may not know everything, but you may know I want to retire in 20 years. You may know today's expenditure, how much it will cost, how much my monthly pension should be, today's expenditure. So you can always include one goal at a later stage also. As long as you review every year with your financial planner, definitely you can include more goals, and you can even see if your retirement years can be decreased, having got the rate of returns. All those things come in the annual review. Most of the people do not do this annual review because they are lazy. Some of my
Yeah.
clients who come after 2 to 3 years because their portfolio is not performing, they come for a review and I just take out one or two investments out of it. their
Mm.
CAGR jumps several percent, 2 to 3%. But if they had come earlier, they could have avoided this decrease in CAGR and their earnings for the last 2 years. So it is very essential that, like a medical physical checkup, you also do a financial checkup every year.
What would you say today is the biggest inflation in India? Is it healthcare, education, house? Which account, according to you, is the biggest inflation we have today?
Healthcare and education both are the biggest. Now, groceries and vegetables, the inflation rates have come down over a period of time. Of course, this is a war period, and therefore the inflation might be very high in those cases. But at all times, whether it is COVID or anything, what does not stop is the hospital and colleges increasing their fees, because it is a purely supplier led industry, these two. So
Got it.
inflation is
So,
very high. It should be, medical inflation is around 8 to 10%. Education inflation is also around 10%.
sir, what are the three biggest retirement risks that most people don't estimate or underestimate?
Okay, number one is the retirement corpus itself. Okay, they think a few crores is enough, but that may not be enough to last them 100 years. Second thing is retirement, post-retirement period, calculation of post-retirement period. For example, if I retire at 40, I should calculate my post-retirement period as 100 minus 40, 60. Most people calculate it at 80 or 85. That's another mistake that people can make. The third thing is, see, the CAGR of net worth increase of net worth according to your CAGR is an average figure of all your portfolio. But in one
Right.
year, some components of your portfolio will underperform. For example, from March onwards, the share market in most countries have come down by several percentages, right? So, if you are a retired person and you are dependent on your equity mutual portfolio, you cannot withdraw as much as you have planned for. Of course, over the period of 7 years, it will give 13%. But what it is giving me right now negative returns. Where do I? This is called sequence of returns risk. Sequence returns will be there, but in some years, returns will be very low. In some years, the returns will be very high. So, how to withdraw when the returns are very low? When your portfolio returns are very low, how to withdraw is what you have to plan.
How do we plan that? The sequence of returns risk, how do we avoid that risk?
Basically, we do a sensitivity analysis. If the returns goes down by 30 to 40% at any point of time, how much you can withdraw. Based on that, the retirement corpus is calculated, right? So sequence of returns is what you have to foresee. So there are, of course, mathematical calculations. One layman cannot do it, but your financial planner can
Mm.
provide for it. And secondly, when you are reviewing, when you are having such a problem, you must go back to financial planner. You should not do by yourself. You should go back to your financial planner and ask, what should I do? This is my position. Then he will help you out from where to withdraw and how to tide over the periods where the returns are lower.
So, sir, coming to the last question now, for someone in their 20s, right, what is the one most important thing that they should focus on right now?
I would say start early, retire early.
Hmm.
So, retire means it doesn't mean that you lay in your bed and watch Netflix. It means working on what you are passionate about. It means working because you love to, not because you have to. That's a lot of difference, right? So, if you want to
Yeah,
retire early and have a good life, start early, retire early. And also, don't do it yourself. If you are
nice.
not an expert, don't do it yourself. Go to an expert who can do it for you.
Right. So this has been a wonderful conversation. This is going to be very helpful for people who are going to listen to. I know you have so many years of experience in this. So I just wanted to thank you for giving your time here. So yeah, just thank you so much.
Thank you, Mihir. It's a pleasure talking to you.
If you found this conversation useful, you'll definitely enjoy the next one I've linked here. And if you want more real conversations like this, make sure you subscribe. I'm bringing one of these every week.